Long before the world knew of stock markets, digital currencies trade was a simple, tangible affair. Imagine a farmer with a surplus of wheat who needed a new pair of sandals. He would have to find a shoemaker who had sandals in his size and who also needed wheat. This system, known as barter, was clumsy and inefficient. Wheat could rot, livestock could fall ill. The solution: precious metal, gold, silver. They did not rust or decay, they were easily divisible. They were portable across long distances. So societies began to mint coins. Standardized units of weight, standardized purity, that represented a fixed value. A farmer could sell wheat to anyone for coins, then use those coins to buy sandals from any shoemaker. Money untethered trade from barter. It allowed complex economies and specialization, but it created a new problem: security. Merchants, landowners, they accumulated coins and became targets. Thieves, bandits, a sack of gold, a heavy burden. Carrying large sums was risky, storing at home invited disaster. A fire could destroy a house, but it would only melt the gold, leaving it for looters to find. People needed a secure place to store wealth, physically fortified, commanded trust and respect. Fear was constant, every journey perilous, every night anxious. This was a deeply human need: peace of mind. The stage was set for the next financial innovation, not from a king's decree but from the sacred heart of the community. The answer to the problem of security was found in the most respected and fortified buildings of the ancient world: temples. Mesopotamia, ancient Greece. They were the center of civic life, built of stone with imposing walls, guarded by priests who were seen as servants of the gods. These structures were considered sacred ground. An act of theft against a temple was a grave sin against the divine. The social and religious taboo provided a powerful, invisible layer of security. People began to bring their grain, precious metals, valuable goods to the temples for safekeeping. The priests, often among the few literate members of society, would meticulously record these deposits on clay tablets. They would note the name of the depositor, the item stored, the date. In return, the temple would often charge a small fee or take a portion of the deposited goods. This was the world's first storage fee. For the first time, people could separate ownership from physical possession, entrusting wealth to a larger, more secure institution. A monumental shift, the conceptual groundwork for banking. The priests soon realized the grain and gold in their vaults was idle. Most depositors did not come back for their goods all at once. This idle capital was an opportunity. In medieval Europe, the goldsmiths emerged as the new custodians of wealth. Much like the priests of old, goldsmiths had the necessary infrastructure for security. They worked with precious metals, strong vaults and secure workshops protected their inventory from theft. People began to see these fortified locations as ideal places to store their personal hoards. Gold coins, silver coins for a fee. The goldsmith accepted the deposit and issued a written receipt stating the amount held. These receipts were a pivotal invention, initially simply proof of deposit, present receipt to retrieve gold. Traders soon realized the receipts themselves had value. Instead of withdrawing heavy coins for a big purchase, a merchant could hand the goldsmith's receipt to the seller. The seller, trusting the receipt was backed by real gold, accepted it as payment. Receipts began to circulate as a substitute for metal. This was the birth of the banknote. Goldsmiths noticed much deposited gold was never withdrawn. Most receipts simply changed hands in the marketplace. This gave goldsmiths a risky idea: issue more receipts than the gold they held, lend the extra receipts to borrowers and charge interest. Fractional reserve banking. The start of banking as business. Goldsmiths were creating money, not just safekeeping it. They lent money that didn't physically exist, relying on depositor confidence. But a rumor of insolvency could spark a run on the bank, panicked depositors rushing to withdraw gold, bankrupting the goldsmith. This was a high-wire act. While goldsmiths and religious institutions laid the functional groundwork, the concept of a formal, state-chartered bank actually took shape during the Italian Renaissance. The Italian city-states were bustling hubs of commerce, but finance was often dominated by private moneylenders. They charged very high interest rates, a practice called usury, which was condemned by the church. This created a social problem. Poor citizens were trapped in cycles of debt. The leaders of Siena sought a solution that was ethical and economically sound. In 1472, the magistrates of the Republic of Siena consolidated several charitable pawnshops into a single public institution. They named it the Monte dei Paschi di Siena. Monte, meaning mount or heap, the initial collection of funds. Paschi, referring to the public pasture lands whose revenues guaranteed the bank. It was founded as a Mount of Piety, a non-profit designed to make charitable loans to the poor. Its primary mission was to serve the public good, not enrich shareholders, counteracting predatory lending practices of the time. Unlike informal goldsmith operations, Monte dei Paschi was formal and publicly sanctioned. It operated under a city-state charter, giving it legitimacy and stability. Its functions included accepting deposits from citizens, guaranteeing their safety under state protection, and providing low-interest loans, especially to those who couldn't access commercial credit. This model, based on civic duty and community welfare, was revolutionary. It showed a bank could stabilize society, not just make private profit. The creation of Monte dei Paschi marked the beginning of the modern era of banking. It established a blueprint for a regulated, institutionalized financial system. The bank survived for centuries, evolving into a major commercial bank. The fundamental principles that governed the first banks in Mesopotamia and Renaissance Italy still form the bedrock of our modern financial system. When you deposit your salary into a bank account today, you're acting on the same impulse as the ancient merchant who entrusted his gold to the temple priests. You're trading the physical possession of your money for the security and convenience offered by a trusted institution. You believe that the bank will keep your money safe and make it available to you upon demand. This trust, whether placed in gods, goldsmiths, or government regulators, remains the invisible currency that makes all banking possible. Similarly, the practice of fractional reserve banking, pioneered by those clever goldsmiths, is the engine that drives the modern economy. When you deposit $100 in a bank, the bank doesn't just lock that money away in a vault. It's legally required to keep a small fraction of it in reserve, but it lends out the rest to another customer who might want to buy a car or start a business. This process of lending actually creates new money, expanding the money supply far beyond the amount of physical currency in circulation. That's why the total value of all bank accounts in the world is vastly greater than the amount of cash. Banks, in essence, create the credit that fuels economic growth. The services offered by a modern bank are, at their core, just sophisticated versions of the original solutions. The next time you use a debit card or check your account balance on your phone, just remember the long chain of history that made that simple transaction possible. You are participating in an ancient tradition, one that began with a nervous merchant seeking a safe place for his coins and evolved into the global financial network that shapes our world. A mortgage is a large-scale loan, not unlike the credit extended by a temple to a farmer. An international wire transfer is a high-speed, digital version of a merchant using a goldsmith's receipt to settle a debt in a distant city. The safety deposit box is the direct descendant of the temple vault. The core functions, safekeeping, credit provision, and facilitating payments, have remained remarkably consistent through millennia. What has changed is the technology, the scale, and the complex web of regulations that govern the system. From the clay tablets of Sumer to the encrypted digital ledgers of today. The story of banking is really the story of humanity's quest for security, trust, and prosperity. It reflects our ability to create complex systems of cooperation based on a shared belief in the value of a promise. From the clay tablets of Sumer to the encrypted digital ledgers of today, it reflects our ability to create complex systems of cooperation based on a shared belief in the value of a promise. The next time you use a debit card or check your account balance on your phone, just remember the long chain of history that made that simple transaction possible. You are participating in an ancient tradition, one that began with a nervous merchant seeking a safe place for his coins, and evolved into the global financial network that shapes our world. The first bankers were not merchants, they were holy men. Trust remains the foundation. From sacred vaults to digital wallets, the story continues.